How's it going, everybody? My name is Antonio, and I'm on the barbecue today on November 21 with Tony and Retta, the co-founder and CEO of Tectonic Metals, a gold exploration company with 2 assets in Alaska. Who's not here with us today, though, is your financial advisor. This conversation is not going to include any recommendations to buy or sell anything. Instead, it will be just a casual talk between 2 people on the internet. And if your mom didn't tell you, you're not supposed to trust strangers on the internet blindly. So please do more research, because this is going to be a conversation that's general and impersonal nature, and it's also not a conversation that you want to use as independent research, because it's going to include a lot of forward-looking statements about uncertain events that may or may not happen in the future. Setterplus.ca is the website where you can find official filings of companies, and that's where you want to go before taking any investment decisions. And also, of course, just consult a professional investment advisor before, again, taking your own decision in the end. That all said, Tectonic Metals is listed on the TSX Ventures Exchange under the ticker symbol TECT, so TECT, right, TECT, where an average of about 500,000 shares trade each day, with a market cap of about 48 million Canadian dollars and about 276 million shares outstanding, although actually I should make note, because I just saw it, it's about 310 million shares outstanding. And then this is a 15-cent stock with a 52-week high of 20 cents and a 52-week low of about 10 cents. There are roughly, give or take, 105 million option and warrants for a total number of 416 million fully diluted shares. For about 3 months now, over 20% of the company has been owned by Crescat Capital. 10% is owned by Donlin Limited, which is the, by the way, this is the largest. Oh, it's not the largest, but it is a large one. So it's nearly 1,000 employees company that is operated by the natives, or the First Nations population of Alaska. And so they own 10% of this company. Then another 15% is in the hands of insiders and other institutions, resulting in an estimated effective float of about 140 million shares, or a little less than half of the total number of shares outstanding. Back at the end of June, Tectonic had about $4 million in cash, which after the August raise of $7.7 million is now probably a bit higher. And there is also $430,000 in total liabilities made of account payables and no long-term debt. As I mentioned at the beginning, the company has 2 projects. We're going to be focusing on one of those projects and maybe touch upon the second one towards the end. But the main focus here is the Flat project. It covers 92,000 acres, which is about 365 square kilometers for people using the right measuring tools. And this project is in southwestern Alaska, about 40 kilometers from the Donlin gold deposit. That's a large 27-year mine life, undeveloped gold deposit. The project, so the Flat project, is also 100 kilometers as the crow flies from a small town called Holy Cross, and it is accessible by a plane which lands on about a 4,000-foot strip, so it's large enough to carry, for example, a C-130 Hercules, which has a payload of about up to actually 45,000 pounds. So in normal people's terms, it's a big airplane that can land about 7.5 kilometers from the project. Project is also accessible by boat, basically by a river barge, and that's accessible 6 months of the year. And the river can be used 6 months of the year. There are 2 main target zones in this project as of now, that being the Chicken Mountain and the Swinging Dome, target. And gold mineralization here is found in intrusive hosted sheeted quartz veins that's comparable to your Fort Knox or the Eagle Gold Mine. And why I'm talking about mineralization already, given that this is sort of a pre-assays story as of now, is because this is not just a thesis. Specifically on Chicken Mountain, gold was first discovered in 1908, I believe, and about 1.5 million ounces have been mined in a placer setting, basically scooping up dirt. And so a total of 11,000 meters of drilling has also already happened on this property since the 60s, I believe. And those were a total of 55 historic shallow drill holes, all of which intersected mineralization. And 25 of them even ended in mineralization at a depth of up to 200 meters. The average depth of those 55 holes, by the way, was about 100 meters. And all that resulted in a total mineralized strike length of about 1,000 meters, which the company says remains open and is potentially trying to extend this year. Historic grades, again, historic, so not as high confidence, but historic assays have showed grades as low as 0.7 grams per ton over 61 meters and as high as 12.5 grams per ton over 25 meters. The company's already done some metallurgical work, preliminary metallurgical studies here on this project, and they showed a potential for up to 96% recovery. So we are indeed talking about a potential open pit target that could be heap leachable. Again, notice the potential in the could and this and that language, because this is still an exploration company. We don't know for sure, and these are your forward-looking statements that I mentioned at the beginning. Tectonic is currently implementing its initial drill program, though, which is set to diamond drill up to 5,000 meters and test a 4-kilometer long, so a rather large geophysical anomaly, specifically a gold in-soil anomaly on the Chicken Mountain project. And the assay results here are expected in Q1 of 2024. So, as I said, this will be the focus of the conversation today, which means that I should be shutting up by now and welcoming the Tectonic Metals' CEO, co-founder, Tony Retta. Thank you for investing your time in me, sir.
Thank you for having me. It's a pleasure to be here.
Pleasure is all mine, of course. What am I missing in the overview of the company here? What did I get wrong?
That's a very humble question of you to ask that. What did you get wrong? Our second target's Golden Apex, not the Swinging Dome.
Okay.
You got a lot right. What else could I say that yeah, I mean, I think most of it is correct. You can let the airstrip actually is on site, so the 4,000 foot long airstrip is actually on the flat property. And to drive from the airstrip to the main target, it's about 7 kilometers. So we do have a series of trails and roads that we can utilize. So I think just to clarify that, and the historic results, you were right in your understanding that historic drill results sometimes can be not totally relied on. In our case, most of the historical drilling, we do have the drill core, and we've re-assayed it to do the metallurgical sampling program. So we also have the old assay certificates. So we actually have a high degree of confidence in the historical drill assays.
Well, that is a good point.
That's not always the case with other projects, though, just to be perfectly clear.
Okay, no, that is a very good point. I do want to, and we're going to be talking about the recoverability for sure as we move on. I do want to talk about, as I mentioned, gold was found there over 115 years ago in this region. Placer mining happened. People drilled some holes, as you said a while ago. Yet nobody moved the project forward in the fashion that you're hoping to do so. How come? Why do you think you're the chosen one?
I think great. Well, there's a few reasons. So if we sort of rewind the clock to day one at Flat, the Flat project was historically mined via placer mining from 1908 all the way. It actually occurred for about 40 years or so, and various degrees of activity. It's the fourth richest placer mining jurisdiction in all of Alaska. The next, so that was placer mining. The land position was also quite convoluted. The Alaska Native Settlement Claims Act took place in 1972, and that's where the various native corporations had the ability to had the opportunity for settlement, and they selected their land. Some of them selected it based on mineral prospectivity. There was other corporations selected for various other reasons, but we had at Flat a very convoluted land position. There was state-owned land, federal-owned land, private land, native land. So that was all consolidated, probably post 1972. So 1975, 1980 by the Native Corporation we're currently working with. The first group to go in there and do actual work like we do, which is hard rock exploration, was in the mid-'80s. It was a company called Fairbanks Gold. So they worked from 1985 to 89. And their biggest discovery was the Fort Knox mine, which is sort of the poster child for this deposit style. It's owned by Kinross. It's in production still to this day, but that's located right on a highway. So they focused their time and energy on that asset. And then in the mid-1990s, another junior mining company that was private worked our property and did the remaining drilling. And in 1997, Bre-X happened. And for those that don't know, that was the biggest mining scandal our industry has ever seen. It actually caused the collapse of the Vancouver Stock Exchange. You might be asking, what exchange is that? Well, the Vancouver Stock Exchange no longer exists. It merged with the Alberta Stock Exchange, which is now then amalgamated with the Toronto Stock Venture Exchange. But this Bre-X was so significant that it literally deteriorated the entire mining space and any stock that you owned on that exchange. And gold, so the industry, that was 1997. When that happened, 1999 is when the exchange collapsed. Gold also tanked below 200, and this property got abandoned because that junior mining company no longer existed that worked this property. Now, the Native Corporation that we work with, they manage 12.5 million acres. Well, that's a lot of land, but oil and gas has been mainly the item that's been buttering their bread, so to speak. And so managing all these acres, the industry kind of, post 2000 kind of being in the toilet, if you will. So this project got put on the shelf and kind of forgotten. And it wasn't until we came knocking where we were essentially trying to understand more the Donlin gold deposit, which is co-owned by Barrick and Nova Gold. It's the largest undeveloped gold deposit in the world right now. It sits at over 40 million ounces of gold. And it's situated in this mineral belt called the Kuskokwim, which, I always, sometimes we have different project generative initiatives. In this case, I was trying to understand Donlin, trying to find the next Donlin. Is there something out there that's perhaps not refractory? So I approached the Native Corporation and said, hey, what do you have near Donlin? And they showed me this asset called Flat. And the VP of Lands actually said to me verbatim, he goes, I have this project called Flat that Robert Friedland worked on back in the 80s with Fairbanks Gold. Robert Friedland is a mining Hall of Famer, and he financed Fairbanks Gold. And that kind of I was like, okay, I got to take a look at this. So that kind of gives you a little bit of sense of the evolution, why we're the chosen one. Essentially, a lot of people are adverse to Alaska, the remoteness, the cold, whatever else. Gold price played a role, the convoluted land position, and for whatever reason, it landed on our lap.
Why do you think Donlin's not in production right now? I mean, it could have been. Let's put it that way. If this was Africa, it would have been in production. So is it jurisdictionally related, or is there something else that you think is holding Donlin back?
Okay, well, these are just my thoughts, and I'll preface that I'm not on the board or in the insiders of either Nova Gold or Donlin. I'm an outsider looking in with an opinion. It's my disclaimer statement. And I don't actually think it's jurisdiction based at all. I mean, that might play a role in it, but the biggest factor, the Donlin Gold Project produced a feasibility study in 2013. Now, going back to the gold price, for those that don't know, in 2013, gold from 2011 to 2013, gold actually hit almost hit $2,000 or $1,995. I can't remember exactly, but they published this feasibility study in a high gold price environment. At that time, the feasibility study stated a $7 billion capex. So $7 billion to build this. And major mining companies, they want to have stability in the gold price, and then also before they execute a go-to decision to start, permitting and build it. But in 2013, gold collapsed $400 in one day. It was actually just in 2013 in November. We were at it was in April. It was the Denver Gold Forum, and gold dropped $400. And then in 2014, gold hit a low of $1,000. So this project, it wasn't necessarily economic. It's a refractory deposit, hence the $7 billion capex. So you need a gas source, energy source, a lot of capital, very capital and energy intensive project. And then in 2013 onward, with the gold price hovering around $1,000, $1,200, $1,300 an ounce, this project didn't make a whole lot of sense. And then they being Nova Gold and Barrick, they still pursued all of the permits. They actually got all of them except for one. And now we're back in a higher gold price environment. And if you can look at Mark Bristow, the CEO of Barrick or Nova Gold, their commentary around it, they're now moving the project forward. So I think it's been the biggest hurdle for that project is that it's a tremendous amount of capex, and it also is the gold price needs to be, north of $1,900 for this thing to really make money. And the last thing you want to do, because if it takes 3 to 5 years to build the mine, depending on the project or the mine itself, you don't want to be stuck in a low gold price environment where you're breaking even or losing money. So the go-to decision has to be, you have to have good visibility and confidence in the gold price. And obviously the CapEx has to be justifiable. So they right now are, or from what I've heard and understand, is that they're updating their feasibility study, and we'll see where the new numbers land and what the sort of risk reward. But this project, I believe it will be built at some point. It is a phenomenal asset. It is a high CapEx, but it's also, a 25 plus year mine life, and it will change Barrick's production profile by 35%. So it has that ability, and that's what major mining companies look for. When you're producing 3 to 4 million ounces annually, you don't want to monkey around with 200,000 ounces a year. That doesn't really move the dial for the risk reward perspective for a Barrick or a Newmont.
Mm. The reason why I'm asking this is because obviously them, a large company having to move it forward, if they're having any hurdles, I'm thinking about the potential acquirer of potentially, again, this forward looking, but potentially if you find something, who buys it off of you? Is there enough appetite for this specific region? And that's the only example that I have close to it. How do you look at that?
Yeah, that's exactly. So this is part of our acquisition process. Is like, okay, where are there potential synergies? No one's, the likelihood of someone moving into an area and building 2 mills, 40 kilometers apart that can be, you can access either project is kind of, asinine in some ways. But in those mature districts like Red Lake, Kirkland Lake, the Abitibi, that happens. And so when I look at a project, I assess, okay, what's in and around the area, what could be a potential suitor. Then I also ask the question, does this have the potential to be a standalone? And we don't have all the answers to that question, but for me, a standalone project, again, going back to the Abitibi Kirkland, if it has a 5 million ounce, footprint or a 5 million ounce gold endowment, it can justify its own mill, its own setting. The other thing I look for is metallurgy and what would be the CapEx for something like this. So what are the hurdles on the capital side, on the permitting front, on the environmental front that we need to overcome? And is it worth taking on that risk? So it's not, having a major next door is obviously a benefit, but more often than not, that major sometimes is so occupied with their own production, or they're not looking for through additional feed for the mill, that another major mining comes up and steps up and acquires it. So we take this all into consideration, but we're not. I do view Flat as a standalone, and if it can benefit from synergies with Donlin or with a Donlin project, then great. I think that would be advantageous to a lot of people as well.
The land that your project and the Donlin project are on is also different in terms of ownership, basically. So the land that you're exploring on does not belong to you, belongs to the First Nations company that also owns you. How does that, this is topical for this day and age specifically, where local communities want more and more involvement in exploration and in specifically in mining once a project gets that far. How does that work with you exploring on ground that is not yours?
Yes. Well, I think we have to keep in mind that, if it's state-owned land or federal land or crown land in Canada, we don't actually own the land either. We call it ownership, but really what we want to own is the mineral rights, and we have that. So we do own the mineral rights 100% on our property. Our belief or business model is to work collaboratively and with First Nations, or in Alaska they prefer to be called natives, work directly with them. So it comes down to the question, are you just trying to find a project, or are you actually trying to find a mine? And that's I think what separates Tectonic from a lot of other junior mining companies, is that we don't view these as drill plays. We view them as mining opportunities. And in doing so, we want to get community and stakeholder alignment as quickly as possible. So we prefer to work on native owned land. The other benefit of working on, say, native owned land it's like it's a private landowner. We don't have to go through all of the rigmarole or the regulatory process that you would if it's on state or federal land. So it is a much more streamlined process. Now, the caveat being is that providing that the native corporation or the First Nation wants you there and wants to work with you. So we start off our acquisition process by having those conversations with the native corporation and say, okay, do we want to work together? Are we like-minded, aligned, so on and so forth? And the native corporation that we've partnered up with, there's 100% alignment, so much so that they've actually invested their own capital into our company several times now, where they are our second largest shareholder in our company.
I think that's an important point there, because of what there's just a whole lot all across the globe that we've seen regarding local population and stuff like that. So it's an important point to get across. Let's talk about your 2023 drill program at Chicken Mountain a bit more. Then, how many holes have you drilled as of now, and how many are remaining?
Well, the program's complete, and we've wrapped it up, and we've drilled about almost 20 holes. I think 19 holes to be exact. And it was a combination of diamond drilling and RC drilling. So there was the historical drilling that we all know about, and we've mapped and put into 3D and studied, so on and so forth. Or we've stepped out along strike from that, and then we've also drilled down dip or at a depth to 450 meters, and then we've taken the RC drill to do more rapid sort of scout drilling in and around the old historical drilling, and so into new areas, stepping out from the old historical drilling where we think there might be a confluence of potential structures. Essentially, we have this big golden soil anomaly that's 4 kilometers in length, and it even needs more drilling, but we wanted to kind of get off the beaten path and test a few areas and see what we can come up with.
Okay. How far have you stepped out from historic drilling?
We've stepped out 400 meters 200 meters on one side and 400 meters on the other side.
Right. Okay. Well, that's obviously an important one too. When you started off this program, you started off sort of with 3 goals in mind. One of those was to define the structural orientation of the mineralization, obviously. Second one was to extend the mineralization beyond 100 meters vertical depth. That's why you mentioned the 450 meters. And then also potentially to discover a new zone of mineralization outside of the known occurrences, if you will. How was the focus of this drill program split on each one of those goals? What was the main focus, and what did the other 2 get?
Yeah, I think what we try to do is, I think it's important, as we outlined in that news release and you commented on, is actually say, okay, what are we trying to achieve here? And I think it's important to highlight this is our first drill program on this asset. So with every drill program, you're learning. They call the drill the truth machine. It's also the learning machine. And for us, understanding the geology at Flat, we have grades up to 200 grams, which you commented earlier on, and the grades as low as 0.2, 0.7. So we want to understand, how do we get more of the 200 grams per ton? Or how can we target more of that? And that's where the oriented diamond drilling comes into play. By that tool wasn't necessarily available back in the mid 80s or mid 90s. And so that's going to be our key thing, is understanding the structural orientation of the mineralization. Is there something controlling the high grade, which there typically always is? Understanding all the different lithologies, and that's where the key is going to come from the diamond drill, to get that data, to actually hold the core, study it, look at the orientations, and then use that to model going forward. So to me, that's going to be the biggest win. Yes, stepping out along strike and hitting gold, that's going to be awesome too. And how do we handle a 4 kilometer golden soil anomaly? It's like it's a blessing, and maybe I don't know if I'd call it a bit of a curse, but when you have so many targets, or a large golden soil anomaly, like a lot of deposits are 500 meters in length, a kilometer in length. We don't know if the full 4 kilometer golden soil anomaly is a 4 kilometer long deposit, but we do know that it's indicative of bedrock mineralization, and it warrants testing. And that's just one part of the system. Then there's the other targets, the other side of Chicken Mountain, the other potential intrusions. So that's why we wanted to get off of the current sort of path where all the historical drilling is situated, and see, is there a better part to the system? And again, sometimes you don't answer that in one drill season, but that was the point of the RC drill. So we're extremely excited, eager to see the results. But I'm also telling my team that, hey, Rome wasn't built in a day. Well, let's take this data and really understand it. And if you look at discoveries that other previous explorers have made, some of them, it took 2-3 drill seasons before they finally got it dialed in, and that's kind of understandable given that you're trying to target something that's below your feet. So this is very much a learning exercise for us. And the data that we're going to get, we're feeling good that it's going to be mineralized, but at the same time, we're going to learn a lot to then apply to next year's program and be even more effective.
And you said that results will start rolling in there in Q1 of next year. Is that still the plan, or could you put something out before that too?
Yeah, we're open to putting something out earlier. I think for us, given that it started a bit later than what we started late, finished late, and also to get the samples to the lab. We are in there's no lab right next door. We actually had to ship our samples all the way down to Reno, with ALS, which is the most preeminent laboratory out there. Vancouver, the ALS also has a lab facility in Vancouver. That was completely backlogged. So we bypassed Vancouver based on their guidance that we'd get sort of a quicker turnaround time. So we might start getting some assay results, mid to late December. But it's also, contextually, you want to, if you issue a drill result, you want to have other drill holes, or you want to be able to provide context so we and the reader understands, okay, what does this mean? What's the significance of this? So the likelihood of us getting something before, December 15th is pretty slim. There is a chance, but, I would say January is probably the most opportune month where we will get a good chunk of assays, and we can then disseminate it accordingly.
And that's also when you're going to start planning your 2024 potential program, right?
Yeah, I mean, we're thinking I have a board meeting next week, and I'll just share what I like to bring the sort of the human element even to the board meeting. So we do my talk is going to be lessons learned and a primer for next year, and so I use that for management to present to the board some ideas and thoughts for next year and what that could look like from a budget perspective, exploratory perspective. Corporately, what that could look like as well. And then in Q1 of next year, that's when we start presenting our formal budgets for approval to the board, and we start laying a roadmap for what the year could entail. So that's kind of we start thinking about that. Yes, in Q1, sometimes you need capital, which is more often the case. So that sometimes happens in Q2, but it's all part of the plan instead of just flying by the seat of your pants and saying, okay, what do you want to do? So next year, I can tell you right now, the way I'm thinking about this project, it needs a much larger program, and we need to test at least with a few holes all these targets, which is quite a big ask, given that the property's massive, and we have 6 intrusion or potential intrusions on the property, which in unto itself, each intrusion could be its own sort of company maker. If this was a more mature district, we wouldn't have the ability to tie up all these different these targets. That's also one of the reasons why we like Alaska, and also like working with the native corporations, that we've tied up the entire belt. So this is something could be very, very large.
Well, yeah, you mentioned that. What is it? 11 kilometers of anomalies total, and that's
It's 20 actually.
Oh, okay.
We've actually extended the property
Because that's
one
right.
of the news releases. Yeah, so it's now a 20-kilometer geophysical anomaly, and you can see these intrusions are sort of like donuts, or Quentin from Crescent calls them mushroom plugs, where they've come up, so you can see up there like strings on a pearl. And all of them, they have indications of potential mineralization. Some have been drilled, some haven't. Some are potential sources for placer gold mineralization. So they all warrant a drill program next year or the year after.
Sure, and I understand that they do, but obviously, it's a large project to explore, and a big drill program is nice and all, but it's also costly and could be dilutive to existing shareholders too. Have you considered, as a company, or is it on the table for the board meeting next week to talk about potentially attracting a major, someone who can fund it alongside you?
Yeah, definitely. I think my approach as a CEO is to maintain all options on the table. So, you don't know where the share price is going to be. You don't know about capital. So maintaining optionality is I would tell any CEO that's first and foremost the most important thing to have as a public company. You want to keep your options open. So, we would and entertain that subject. Obviously, it has to be creative and the terms have to be right. But we do have conversations. We do have companies under CAs or non-disclosure agreements. It's a matter of being a right fit for them, the right time, and vice versa. So that is very topical and conversations we entertain.
So where I'm coming from with this, and it's going to make sense in a couple of questions time, I suppose.
Sure.
But earlier this year, when you elected to terminate the lease on your previous project, I believe it's called the
Mm-hmm.
70 Mile Gold Project.
Yeah.
You had done 3 seasons of exploration on it, and you said
Mm-hmm.
that you had terminated because of basically discipline. And so you said that basically it was part of your business model, and that every project that you acquire has to meet certain exploration plans. You said that it has to have a linear, definable, and what else? Linear and definable
Clear
path
path
forward
forward.
is what you said, right? And a
Yes.
tangible, real annual deliverables. That's exactly what you
Yeah.
said. Like I wrote it down. But so I'm trying to understand what success looks like in your eyes with the flat project. So what
Mhm.
would it take for you to terminate the flat project, and what would it take for you to push for an even larger exploration program?
Yeah, thank you for reading the news releases. That's great that you've noted that. So with this project or with Flat, for example, we do have a 3-year plan, and my board holds me accountable to it, and I hold my team accountable to it. So year one for Flat, if I were to sort of do it sequentially, was to understand the project, understand the system. So how do we do that? Well, we put all the historical data into 3D. So 3D imaging modeling, we relogged all the historical drill core. We took those samples from the historical drill core and we did metallurgy. And we didn't just do one metallurgical test. We took 13 holes, composites, took samples from all 13 holes, made composites to mimic sort of what a very loose mining situation would look like. And we did bottle roll testing, gravity, float, gravity and bottle roll. And then we did bottle rolls at different crush sizes. For someone who's never drilled a project before, to my knowledge, I think we might be the only company that's ever done that extensive metallurgy before going into their first drill program. So year one was about understanding and de-risking. We then took the geophysics, did a reinterpretation of it. We brought on structural geologists. We brought on mining engineers. That was all part of year one, and then year two as well. So now with this drill program, our objective is to, again, keep learning, understanding, but to see, okay, what are potential indications of scale, grade, and then continue with the metallurgical test work. And what I see is year three next year would be to continue to show scale, to better understand the system, get a flavor for what the grade could be. But we're not going to, fully understand the system based on, 20 holes from our first program, especially given that there's all of the drilling was all on Chicken Mountain. We didn't get to the other targets because some of them we acquired just about a month ago. So I want to, next year I'd love to, do a full prospecting mapping, soil sampling campaign on some of the other targets, and then continue with the drill bit, understanding Chicken Mountain, a few holes in Golden Apex. And then we have the new targets that, if we can get to a point where they're drill ready, execute a few holes into that program. Then we not definitively, but we know at least we can sleep at night because we've tested the bulk of the targets. And until that's done, we're not going to fully understand the system. We're not going to fully appreciate the scale. So to do all that next year, you're looking at probably at least a $10 million program. Now, what I want doesn't mean I always get what I want. I tell this to my kids too. So even though I want to do it like this year, I wanted to do a $10 million program, but capital markets, share price, dilution, all those factors come into the conversation. And there'll be a conversation next year that's had along those lines is, how much dilution do we want to take to execute this program? And sometimes the market, it's not there. So, this is where having a plan is important and having discipline. And then it's like, okay, what can I do instead of for 10 million? What can I do for 5 million? And then it's like, okay, well, should I bring on a partner? But it's so fluid and active. You have to really maintain flexibility and be malleable to pivot in every situation. And it's just one of the challenges of being a public company. So that I don't know if I think I may have answered your question, but did I address it, or did I? Hopefully, I didn't dance around it. I mean, what I want next year is to show more scale, understand the system, but to do that, it's going to be at least a $10 million program. I still $5 million, sure, we'll take another kick at the can and have a go at it and do what we can for 5 million, but it might not fully test the system.
Right. Well, there's basically two things to talk about here that could get us talking about something more specific, at least in my opinion. That's recoverability and obviously grades, and we can talk about the historic grades. But on recoverability, your preliminary metallurgical work showed 96% recoveries, if I'm not mistaken. That is on the high end for just about anything, but definitely for intrusive hosted sheeted quartz veins, because of what we see at like Fort Knox, what is it, 80%? And what we see at Eagle is as low as like 70%, even below that. So, I mean, I understand it's preliminary, but how or why is it higher for you?
Well, it's just the way the gold, there's a lot of factors. So the let's just call the other elements that are associated with gold. Some of them impede the recoverability. We also didn't do like a series of crush sizes. So it becomes a trade-off study as you advance the project. Is like, when I say a trade-off study, it's like, okay, do I want to crush the rock more to get a higher couple more percentages? You go from 88 to say to a certain crush, you can get 95%, and then at a coarser crush you can get 85, and even run a mine you get 80, but you save on energy because you're not crushing rock. So that's the trade-off study that I'm talking about. And so this was just a first pass to understand the mineralogy, the characteristics. Is there anything, we call it preg robbing, that's impeding the cyanide from being absorbed to allow for greater recovery? And in order to do that, you have to do a whole series of tests. So that the gold at flat appears to be very finely disseminated. It's not necessarily coarse or nuggety yet, based on the mineralization we had to test, and it pops out quite easily. And so these are all extremely advantageous. And the biggest, the metallurgical work that we did, yes, we got 96% recovery average, but my biggest thing that I loved is that I have optionality. I'm not stuck to one specific metallurgical processing technique. We have options. And depending on the grade, sometimes those extra few percents, you don't want to put it on a pad, or you don't want to process it in this manner. So that might lend itself to building a mill. So it's definitely a first pass. We don't know definitively if heap leaching is the best route, if a mill is the best route. But as far as a first pass is concerned, you couldn't ask for better results.
Yeah, well, I agree, and I'm sort of trying to understand how that could even be possible, given that that's not the case for some of the larger mines. And I'm also thinking about how's that going to evolve into the future when it's not preliminary, but it's metallurgy on your own core relative to the historic core. So those are things that I'm thinking about, but I understand that's not something you can tell me right now, and that's something that you basically have to wait and see how it goes. Looking at the historic drilling, there seems to be quite the wide variation in grade, from sometimes from 0.7, even half a gram per ton, to over 12 grams per ton of gold. Is that something that's top of mind for your technical team, and how do you look at that, and how do you deal with it?
100%, it's top of mind. There's these, you talk about quartz sheeted veins, and sometimes there's these stringers that just rip. They're not terribly wide, but they can, you can get up to 200 grams in these like skinny little veins. So that is definitely top of mind. And how do we target it? And also why we brought on the structural geologists. We know that with every gold system, structure plays a huge role. Sometimes there's a confluence of structures. That's where you get their dilation points, you get intensity mineralization. So this is all part of the puzzle that we're trying to put together and figure out, okay, how do we target more? Sometimes there's a different host rock. Sometimes it's a structure. Sometimes it's at depth or where you sit in the deposit model. and all good problems to have, and we're up to the task for definitely understanding it. Right now, though, it's a plus to have this really high grade. We don't really fully understand what's controlling it, and that's perfectly normal for any gold system. Sometimes it takes years to figure this one out. So we're up for the challenge. It's just going to take time to say, okay, this is the reason why this is the case, and usually there's a dip or a plunge or some sort of structural orientation. And once you vector into that, then you map it, and then you target your next drill hole and see if you can hit it again. We can also tell from the historical drilling, they were drilling in different directions. Again, they didn't have the ability to orient their diamond drill core. So if someone's drilling consistently in the same manner, it's easy to map out the plunge or the continuity of the mineralization. But when they're firing holes in different direction and there's no specific structural measurements, it's anyone's guess to what's going on there. So we want to bring some predictability with the drill and the structure. And then again, this year we think we got it right, but it's going to take the assays and the data and then mapping that all into 3D, logging all the core, and then saying, okay, this is where certain host rocks, there's mappability amongst those types of host rocks. There's mappability along these veins. So it's really next year's program that's going to say, okay, let's go test this new theory out. We'll collect more data next year, and then we'll do it all over again. And that's sort of the nature of the beast when it comes to understanding mineralizing deposits or mineral deposits. Sorry.
Yeah, and I understand that obviously takes time, and you want to see the results before deciding on it, before properly understanding it. Which is also why I was surprised when I saw that you recently acquired more land basically. So help me understand the thinking of acquiring more land before having seen the assay results from Chicken Mountain.
Yeah, I think so. We did with our project, we sort of take a 30,000 foot overview, and to understand what's happening right here, right now in this project, you have to take a step back and understand the entire mineral belt. And we don't have it fully understand, but what's our relationship with Donlin? Why are we different? 40 clicks away. We're in the same broader mineral belt. And in doing this, then we looked at the geophysics, we looked at other anomalies, and there was these ones that were literally looking at the geophysics right along, all connected. So our rationale was let's understand that. So we spoke to one of the landowners, and we were able to, I think, execute a fairly attractive deal on the property. Also, the ground next to us was open. So the rationale was, before we get any results and the market understands what we have, let's tie up the land or the remaining portions of the flat gold system now versus later, because A, the prices might go up, and B, someone else might scoop us. So it was that was kind of the rationale. Geologically, it made sense because we think all these pearls on a string are all connected back to Chicken Mountain. They were all once connected, and they've been pulled apart through fault activity. And so we were like, okay, let's move now. It was the end of the season, tie it all up, and it just makes sense also from an operational perspective that, if Tectonic's doing work at Chicken Mountain, which is what I told the landowner, we're the best person to test your property because we understand the system, but also we have drills right there. And to pop over a drill to the next anomaly, it's much easier than someone else coming into the area, another company, and saying, okay, I want to work your property. Well, good luck. That doesn't have an airstrip or doesn't have the roads. It doesn't have the operational equipment. We have the camp. So there was good synergies for both us and him, the landowner, where it's like, okay, we have the best chance at advancing your property because we understand the system, and operationally we have all our stuff there already. So it was just good timing, and I think it was advantageous, and obviously the market responded quite favorably too.
Right. Okay. And that's a flat project specifically that you're sort of expanding. Might as well talk a little bit about the Tibbs project, unless I'm missing something on flat. Is there anything you want to talk about on flat before we move on to Tibbs?
No, I think we covered a good chunk of it. I mean, yeah, so we can move on to Tibbs.
Sure. Okay. So what's happening at Tibbs? Where's that? What's the plan?
Well, the plan right now, it was to just desktop work is the main focus there. We own it 100%, and it's a project that we still have a lot of love for. It comes down to people ask me, how come you're not working TIBS this year? And the analogy I use is, say you have two children, but you can only afford university for one of them. So you have to pick which child's going to university. In this case, Flat was the golden child to go to university. Also, one of our shareholders, i.e. Crescat, was a pretty big fan. Well, both properties, but more specifically, they wanted to see Flat being worked. So we do have the luxury at TIBS to put that on a shelf for a little bit. But as far as the next steps on that project, I mean, it's near a mine that needs feed. So that's a bonus. We know where we want to put the drill. It comes down to, our 3-year plan. We talked about discipline. Well, discipline's also, we had to say, okay, we're not going to incur more dilution. We need all this capital to go to Flat, and we have to just hit the pause button on TIBS. But if you were to say, Tony, here's $5 million, we actually know where we want to drill. And it's actually a fantastic target. There's 2 fantastic targets there. We've done a total reinterpretation on the structural orientation on what's controlling the high grade there. And it's very similar to Flat. So we've drilled this target. It's called Michigan at TIBS. And we were drilling in what we thought was an optimal orientation, and we were hitting good gold grades. But what we've now realized is that there's multiple structural orientations, and we may have been drilling parallel to the mineralization. And this new interp has about 10 drill intercepts, the best one being 104 grams over a meter. We have 19 grams over 3.5 meters. We have 52 grams over 2 meters. All the high grade, when you raise the cutoff, is all sitting in this newly interpreted structural orientation. And we happen to be drilling parallel to it. So we want to drive it, put a drill hole through it, across into it, to see what's the true width of the structure. And, to mobilize a drill over there, you're looking at a $2.5 million, $3 million program. And, we're up to doing that. And right now, though, it's just the capital was, specifically dedicated to Flat this year. But that would be the next step, is to drill across that structure. And we do have another target at TIBS as well, but I'll just, leave it at that for now.
What's the drilling cost, by the way, at Flat? We didn't talk about that per meter.
Sure. Everyone asks that question. It's a great question to ask. I would encourage, our industry doesn't have a standardized formula, just like in 2013, when gold collapsed $400, and then the major mining companies and the investment community more specifically realized that, hey, all these major mining companies are using different formulas to calculate all-in sustaining costs. And then when the World Gold Council standardized their formula, it was like, oh shit, we're not making money on this mine. because now the majors were all, it was somewhat enforced, or institutional investors were saying, you know what, you have to use this formula. What does it mean? So when people say, what's your cost in all per meter? Every junior mining company, I would speculate more than half, we're all using different formulas to come up with it. But I can say for our project, it's going to be a lot higher, because this was our first year, and we spent millions into infrastructure, like camp, improving the airstrip, the road system, bringing fuel tanks in. All that stuff is now in place for next year's program. But if you were to look at the cost per meter on this year's program, it's about $1,000 a meter, which people's like, oh, it's kind of high. Well, yeah, it kind of is. But with time and more drilled meters, we want to bring that back down to below $1,000.
Okay.
Which I'm pretty confident we can do, because we've done it at other projects.
Okay. And you expect that to be the case for TIBS as well?
Oh, yeah. TIBS. Yeah. TIBS is actually, you can probably do it even a little bit cheaper, just given its location. Then also depends on the type of drilling. Like if you're doing RC drilling, even at Flat, we can do RC drilling for about $500, $350, $500 a meter. And at TIBS, the exact same thing. So, and it's also, remember, like for those that don't know, I just shouldn't assume everyone knows, but if you want to execute a drill program on a project, say whether it's TIBS or Flat, bringing everything in, and then you have to get everything out. That's like 60% or 70% of the cost. The actual cost to drill, to get the drill contract, it's like 2-3, depending on the amount of meters that you commit to, it can be 400,000, 300,000. But to get all the equipment in there, that's where the big upfront cost is. So when you ask me about TIBs, like if you're going in there just to do few, like say, 3,000 meters, then the mobilization and demobilization all gets lumped into that 3,000 meters. So it's your cost per meter is going to be much higher than say doing a 10,000 meter program.
Okay.
But we've budgeted $3 million at TIBS gets that Michigan target test and possibly one other one. Again, depending on the amount of holes that you want to do.
Okay. So why I've started asking about this is because I'm thinking about, obviously I'm thinking about money, I'm thinking about the financials.
Yeah.
And we might as well then talk about G&A so I can start getting a better perspective. How much is G&A right now, but also how is it weighted in terms of salaries versus marketing versus the rest?
Yeah.
What are you spending most money on within G&A? And again, how much is the total G&A?
Yeah, and you know what I'd love to do, Antonio, is standardize this formula too, because I this is going back to the World Gold Council. This is something that our industry would bring. We just, not to sidetrack here, but I do care about this industry and passionate about it, and I think that we've done this to ourselves in many ways. We have to do better as an industry because the investment community has lost confidence in our ability to be transparent and honest. And we do need more standardized formulas where we can say, this is our G&A cost. And everyone's okay, this is our all-in cost per meter. This is operational cost, so on and so forth. Getting back to your question, our G&A costs, so this is, salaries, public listing fees, office, computers, things of that nature. Keeping the lights on, we're looking at about $75,000-$80,000 a month.
A month. Okay. So you're over $1 million a year, give or take.
Yeah.
Okay.
Yeah.
About $1 million, not over $1 million.
That's also
about
property. Yeah. I mean, I can get that down lower, but that's also property payments, things of that nature, conferences, annual audit fees, quarterly audit fees, all the rigmarole to be public. 2 exchanges. We are on the OTCQB. We're on 3 exchanges: the Frankfurt OTCQB and the TSX Venture. So, you're looking about 80 grand. Yeah, 80 grand. So that's 960,000 Canadian annually.
Mm-hmm. Okay, but the two biggest chunks of that, I suppose, are marketing and salaries. What percentage of the total G&A did those two take up, and how are those two split within?
Yeah, good question. So the salaries, and I don't have this number right off the top of my head, but we do use like our CFO, for example, and accountant. They're shared, so they work for other companies. And that's for us, it works because it's a way to keep the overhead low. So going back to the split for marketing, it's probably, marketing is probably 30% of it, if I'm not mistaken. And, again, that's not, that can porpoise depending on, are you getting traction, this, that, like that budget's not fixed. It can get lowered, it can get increased, so on and so forth.
Right. Okay. Yeah. So 30%.
But the biggest chunk is salaries. I mean, that's you have a VPX.
How many people's on the payroll?
Well, we have consultants, but so we have a CFO, we have an accountant, we have myself, we have investor relations, we have another geologist, and we have a kind of a jack of all trades type that helps on the back office. So we have about 6 people on the payroll, and then we bring in some other consultants on an as needed basis.
Okay. 6 people. That's okay. Good point. And so, but I'm assuming that I mean, if we account for all that, so $1 million on G&A, then you said about 1,000 or even more than that per meter. Does that mean that after this year's drill program, you'll probably be looking to raise money in or around Q1 of next year?
Well, we will raise money next year. It doesn't have to be Q1. We can raise money in Q3, Q2.
Okay.
But there will be a capital raise in order to execute the next drill program. The capital that we raised this year, by design, we put almost 85% of all of our capital. So every year we actually calculate this number internally. As an exploration company or someone investing in an exploration company, you want the dollars going in the ground. So that was, we eat what we kill. And
Yeah.
so if we raised 7 million, we don't sit on 5 and spend 2. We're like, no, we're going to go full hog here. And that's what our shareholders appreciate and why they keep, reinvesting in Tectonic, right? We put the money in the ground.
Right. Okay.
So to that point, we do have to raise more capital next year if we want to do a $5 million program, is what I'm getting at.
And who do you think will who do you think will finance you? Do you think it's going to be some of the parties that already have, like, you're obviously talking to Crescat, you're talking to Doyon. Have they indicated that any willingness to keep coming in, or do you think they will sort of get diluted as you raise capital?
Well, great question. I think it'd be fair to ask them that question. What I can say is that, Crescat for the last 2 years has been cutting a check into our company, whether it's the Tibbs project or Flat, and specifically to Flat, they've this year alone, I think it's been over 2 million. And about 2 weeks ago, they put almost 700,000, and our native partner put about 600,000 to the company via a warrant exercise program. So I think they're in it for the long haul, but market conditions also play a factor in how they deploy their capital. So I think what's important as an investor is to look at the shareholder base and say, are these like long-term, married, put a ring on your finger type of shareholders, or are they, one night stands? And I do think we have a very long-term loyal shareholder base that has continued to invest. And what I would highlight, even on the last financing, this was a terrible market. This is a terrible market. This like, to have them say, okay, we want to reinvest, but to do it in that type of market environment, man, like, I was so humbled and honored that they would step up to the plate and say, no, we're going to drill this project and we're going to support you, Tony. And I don't care how bad the market is, we're coming in. Like, that is, to me, people say, oh, you raised $7.5 million. Like, that's a great feat, but you have to take that in context and look at the backdrop that we were in. Like, this is a terrible market. No one was raising $7.5-8 million in this market. This was July and August of a few months ago.
That's right. Yeah, that's right. And then you also, but after that, you had the warrant incentive deal earlier, last month, I believe. Yeah, it closed this month. Yeah. So you started last month. And that was an interesting move, actually. Was that a one-off, or do you think you're going to be doing more of that as we move forward?
I think again, you have to maintain optionality. And for us, our 2 largest warrant holders were Doyon and Crescat, and they were willing to cut a check. So we started by querying them and saying, hey, what are your thoughts on something like this? And I think, again, when you try to establish from a CEO operational perspective where you get your capital from, we had these warrants, they were in the money. They didn't need to exercise them. They expire next year, but they're like, you know what, we'll take them down early, get you some more capital. And it was comforting. And I think, will we do it again? If it's advantageous to do so and our shareholders are for it, then yeah, I think we would.
Okay. Well, warrants are always a tricky thing to talk about, and also just generally to deal with in the market, because it's great for the current warrant holders, and it might incentivize, if you say, oh, we're going to do that we're going to do that as we move forward, it might incentivize people to come in on the private placement to get those warrants because it's advantageous to people who hold them. Not so great maybe for new investors or people who buy in the open market, though. So how do you balance that?
Yeah, I think it's I think if I was someone who didn't have warrants, I would look at it as a positive. You're getting rid of these warrants that are in the money, so a potential or overhang. They're getting repriced and they're putting capital in the company. So that's one way of doing it. The other way of doing it is just doing another financing. But you're after to my knowledge, I don't know any company in this market that's doing a financing without a warrant attached to it. So you're going to have to issue a unit, which is a share and a warrant. So, or you can just say, hey, warrant holders, can you take this down? And that way there's just another new warrant that's being issued. So I think from an outsider looking in, or someone that's not a warrant holder, I think that would be more creative than doing a whole new financing. You have to get creative in these markets, man. Like everyone's talking about dilution, man. And like, I get it. Like, I'm an investor, I'm a CEO. Dilution's real, but it's, what are you going to do with the money? I don't care if you dilute. Dilution's got this bad stigma, but you don't dilute, you don't put money in the ground. So your choices are sit on your hands, don't do anything, or dilute and put the money in the ground. And that's where it comes down to the team. What are you going to do with that? So we raised that capital. Was it dilutive? Hell yeah. But guess what? Our share price went up, and everyone that's in that financing's in the money. So technically, regardless of the results, we've done our job. Everyone's in the money. Warrant holders are in the money. People in the financing are in the money. You could sell right now and walk away with 50% profit, 10 to 15. That's that in less than 6 months. That's remarkable. So I'm not encouraging anyone to sell, but I'm highlighting that the word dilutive is a necessary evil. You have to do it in order to explore.
Mm-hmm. It's true. It's again one of those things that you have to balance, and the market's perception, you also have to balance that. I feel that in marketing too, like people complain when a company spells on marketing too, but without it, I mean, what are you doing without it? But it's a balance though. You don't want to spend 5 million in marketing and put 2 million in the ground, and so it's the same thing. And
I had a quick question. I had a shareholder. Actually a new potential shareholder. This was 3 years ago, I think in 2020, and they wouldn't cut a check into our company because we were spending too much on marketing. And then we had another shareholder's like, you're not spending enough in marketing because your share price is not going up. I'm like, okay, everyone just, when share prices or shareholders are losing money, the share prices are down, everyone's going to try to look for something like, you got to do this, they got to do this. And that's where you need to kind of quiet the noise and say, you know what, like there is a necessary evil. In order to get your share price up, traditionally you have to explore, but you also have to communicate and market and bring on shareholders, and that costs money too. So you can't have it both ways.
Oh no, absolutely. I agree with that. Again, though, it's a balance. I mean, it's something that I'm happy that there's people out there who are still paying attention to those things, because you have to. And sometimes companies do take advantage of it. Obviously, not saying that you are, but some companies do. And but you're mentioning sort of the previous life of the company, if you will, with the 70 Mile project. As you were drilling that project throughout those 3 exploration seasons, the number of the fully diluted shares got up there, right? It's over 400 million now. Have you considered, or are you considering a potential rollback now that you have a new focus?
Yeah, that's so it's 300-ish undiluted, and then 50% of the shares are tied up in strong hands, right? Mm-hmm. So the share consolidation, yes, we've thought about it, and we've actually put it forward at our AGM. Any kind of rollback or share consolidation, whatever term you want to use, requires shareholder approval. And so we obtained that because we wanted to put that piece in place for a later date. We have no definitive timeline that we need to do this now or next month or next year, but by getting that sort of approved, we have that option. Again, going back to maintaining optionality, we have that available if we elect to do so. Remember, our shareholders voted for that, so we got their approval to do so. But right now, we have no intentions of doing that. And going back to 70 Mile, they weren't like terribly costly programs to do there at 70 Mile. It was also, we had another project, and the thing is too, since the last 3-4 years, share prices for exploration companies have not been fantastic. We've been in a depressed state for years now, and we were faced with the decision in Q1 and Q2 of each year: do we drill, or do we explore, or do we sit this one out? And our shareholders, we raised capital because they wanted us to work. That was the use of proceeds. It wasn't us just saying, hey, we're going to go drill this. It was like, okay, this is going to cost $2 million. Do you want to participate in financing? And this is the use of proceeds. And the answer was yes. So we executed. And the reality is that we are in an inflationary environment. So we talked about salaries and G&A. I mean, I was with Kaminak Gold Corporation previously, and I can tell you in 2016, when we sold that company for $520 million, our G&A, operational costs, the whole industry, just look at salaries, have all gone up. Like, we're talking about like 2 to 5x. So you have the cost to operate a company. Conferences, we're talking market conferences used to be 10,000. Now they're like 20,000, depending on the conferences. the cost to be a public company, auditing fees, filing fees, the TSX has raised all their fees. Everyone, regardless if it's mining, just in general life as a human, costs to live, everything's gone up. Meanwhile, the valuations for exploration companies has gone down. The valuations that we had back in 2015, 16, 14, 17, 18 were up here. Now they're this. So you have this huge low, this is a compounding effect, low valuations with increased costs. And the reality is the days of having 50 million shares outstanding, 100 million shares, they're long gone. If you actually want to put your money to work, you're going to, we as investors or as a community, you have to get used to having companies having a couple 100 million shares outstanding until there's some cooperation or valuations go up. But that's just the nature of the beast that we're currently in right now, as far as I see it.
Right. Okay. But more specifically, what would it take for you to roll back the shares? Like, well, is this something you want to, because again, if you want to drill 10,000 meters next year, you want to do a $10 million program, depending on where you're raising 15 to maybe even 20 cents or whatever it might be. Hopefully, if you're raising higher from here, that's still at least like 50 million shares. So I will answer your questions. I'll go back. So you mentioned a common colleague we had earlier on in our conversation before we started, and he has an issue with shares outstanding. If you bought Tectonic, so our year-to-date performance, you're up 72%. We have that chart in our presentation. 72% year-to-date. If you bought the TSX Venture Mining Index, you're down you're up 4%. If you bought the TSX Index, you're down 14%. The shares outstanding has nothing to do with I wouldn't say has nothing. We would have been up for a company that has a lot of shares outstanding. You would have made 74%. From August to now, you would have made 50% on your capital. So the trigger for us as a company to say, hey, let's do a rollback is when people stop giving us money. If I can't raise capital, then, doing a rollback, will that change? Will that allow me to get more capital in the door? What traditionally happens, in the junior mining space, they do a rollback, they finance, 6 months later, they're in the same predicament. So I like to do rollbacks when A, I can't get capital, or B, there's a transformative event that can be the backstop to create a new sort of platform to build your foundation on. So those are what I would be looking for to say, okay, let's do a rollback now. It's tied to some sort of cataclysmic or milestone type of event that creates a new sort of platform to build on. But if we have we're having great drill results next year and I can get capital, I think we can still create value for our shareholders with 400 and 500 million shares outstanding. I don't see that as an issue. Probably also depends on the market. Sometimes, a rollback is more just a reason that for people to short you back to your previous share price, as silly as that may sound. I've seen it happen. So good point. I've been through a lot of the questions that I want to ask. I think most, if not all of them. What am I missing here? Anything that you came here hoping to talk about but I'm failing to bring up?
We could talk all day. Like, we can talk about the team. I think, I think we covered a lot about the projects themselves. Another thing about the team is that, we're also big shareholders in our company. To have that type of ownership after, X amount of years of being public is good. Not just the board, but the management, and then also our technical advisors that we've brought on board. I would also say, going back to G&A, our board of directors, they don't collect a salary, which is somewhat rare in our industry. Our technical advisors, they don't collect a salary. We're in it because we want to do something meaningful, and we obviously believe in the company and the projects. So I'm very fortunate as a CEO to have a supportive team that is there because they want to be there. They're not there because they get a check.
What's your average cost of shares?
Oh, me personally?
Yeah.
Oh, my average cost of shares is probably 12 cents, 11 cents.
Okay.
Yeah.
Okay.
I have,
just checking.
That's okay. I have about $300,000 into the company. Our founders, the management team, we have close to $2 million of our own capital in the company.
Okay. Yeah.
Thank
you
Some
for
of our
highlighting
directors
that.
have a higher cost base than me, but obviously being one of the founders, I was able to participate even at lower levels and even at higher levels, 25 cents and 35 cents, I was cutting checks.
Yeah. Just recently came across, I don't want to throw anybody under the bus, so not necessarily naming any names, but I came across, founder shares, which would be like a millionth of a penny per share. So stuff like that also happen in our interesting industry.
Yeah. I mean, I think you asked the right question about the average cost base. If someone does a 1 cent financing, whatever, sure, okay, but where are the other financings? And are you continuing to cut a check? I think it's the overall cost base versus just I got all my shares at a penny, right?
That's right. Yeah, absolutely. Well, Tony, this was great. You were responsive to me with your email, so I assume if people have any questions, I can put up your email address on the screen right now, and they can reach out. But thank you so much for investing your time in me.
No, thank you for having me. Great questions. I really appreciate it.